and welcome to Smaulgld. In case you missed it, top gold and silver stories for the week ended January 7th, 2017. Happy New Year. What is the real purpose of the gold futures market? We're going to discuss that today. That'll be the bulk of the review of the week based on a WikiLeaks 1974 cable which reveals the intent behind the purpose of creating a gold futures market back in 1974. In order to understand the 1974 WikiLeaks cable by a U.S. ambassador in London, we need to do a quick review of the history of gold in the 20th and 21st century. So in 1933, Franklin Delano Roosevelt issued an executive order 6120 nationalizing and confiscating the gold in the United States. So all gold coins that were then in circulation had to be turned into the government. Any gold held by individuals, people had to do the same. And from then on, gold was not allowed to be owned by U.S. citizens. In 1944, towards the end of World War II, the U.S. dollar was selected at the Bretton Woods Agreement amongst most of the nations in the world to be the world's reserve currency and the currency that would be used in international transactions. And part of that arrangement was that the US dollar would be backed by gold, meaning not that US citizens who are not allowed to own gold, that central banks who had US dollars and accumulated US dollars, if they so wished to turn those dollars in, could bring them to the United States and collect gold from the US Treasury. Then in 1971, Richard Nixon in August, I think it was August 8th, 1971, went on TV without any advance notice to the signatories of the Bretton Woods agreements and said, from now on, you cannot turn your dollars in for gold. So the dollar is now based not on the Bretton Woods Agreement gold standard, but the full faith and credit of the United States. Now, as a result of this, the expectation was that gold demand would drop, since it was no longer required in the international monetary system, and therefore it had been effectively demonetized among central banks. It had already been demonetized by fiat for individuals back in 1933. So the general consensus was, and not everyone agreed with this, was that demand for gold would be limited to jewelry and trinkets. There would not be this monetary demand. There would be no demand by sovereign nations to make coins out of it. That had already gone away a few decades earlier, and there would be no demand for central banks to hold gold because, other than the gold they already held, because it wasn't required in the international monetary system. Now, in 1974, the United States decided to allow gold to become legal to be held by U.S. citizens. And that was I think that was December 29th, December 3rd, whenever it passed, it was at the very end of the year. But in any event, this WikiLeaks cable is dated December 10th, 1974, just before the agreement or the legalization of gold, so to speak, for U.S. citizens was to go into effect. And they realized that perhaps that 1971 thought that gold may not be in demand that much and only be in demand for trinkets and jewelry. They thought that maybe now that they've had 1972, 73, and 74 under their belts, they've seen inflation as a result of Nixon taking the United States off the gold standard. There was tremendous amount of inflation in the early 70s through the entire decade, that people perhaps may want to own gold in larger amounts and may wish to hoard the yellow metal. And let's take a look at this language coming from Ronald Speer. He says, the belief that a futures market would be significant, proportional, and physical trading would be minuscule. So what they're saying is that the futures market would take the bulk of the dollars and that the physical trading would be minuscule by comparison. Also expressed was the expectation that large volume futures dealings would create a highly volatile market. In turn, the volatile price movements would diminish the initial demand for physical holding and most likely negate long-term holding by U.S. citizens. And there's your answer. The idea that a futures market would dwarf the physical market, thereby undercutting physical demand because people would choose to buy their gold, so to speak, through futures contracts. And because they are futures contracts and they trade in massive amounts, there would be massive volatility, and that would dissuade people from buying and holding gold. So in 1974, gold ownership was made legal again, and it wasn't until 1986 that the U.S. Mint first produced gold bullion coins for U.S. citizens since 1933. And now we're talking about the American Gold Eagle, which was introduced that year. And you can see the first year there was tremendous interest in the coin, 1.3 million sold. Second year, 1 million sold. Now remember, 1986, 1987, these are not crisis years. This is people, it's kind of a novelty. You can now own gold. People start to buy gold. But then look what happens. They lose interest. By 1992, they're selling a couple 100,000. So gold interest didn't pick up again until kind of the Y2K fears at the end of the 1990s. But let's take a look at that in comparison. That's the physical market, or at least part of the physical market. The U.S. Mint sold 1.24 million ounces of gold worth approximately 1.5 billion in 2016, and that includes all of the 1 ounce 817,500 American Gold Eagles plus all of the 1/10, 1/4, and 1/2 ounce American Gold Eagles, and also the 1 ounce American Gold Buffaloes. That's how I get the 1.24 million ounces, and that's worth about 1.5 billion. Decent amount of money for you or me, but not a lot in the grand scheme of things. Now, if you look at the total gold that's ever been mined, I think the World Gold Council says it's about 170,000 tons. That's about 6 billion ounces. That's worth $7.2 trillion at $1,200 an ounce. That's a fair amount of money, $7.2 trillion. Now, most of that gold isn't for sale. It's out there, but that's what it's worth. But let's take a look at the vision from 1974 and what COMEX and LVMA and futures trading has become. It's estimated that the futures exchanges around the world trade about 125 billion ounces of gold a day. That's worth about 30 trillion, no, 125 billion ounces a day, or about 30 trillion. That is $125 billion a day, or about $30 trillion annually. So annually, the amount of gold traded exceeds the total amount of gold almost over 4 times the amount of actual gold there is. And of course, all that gold isn't for sale. So you can see where the futures trading just allows a massive amount of leverage on the existing gold, where they can trade gold they don't have, they can buy gold they don't have, they can sell gold they don't have, and they can do it in multiples. And here are some charts from Nick Laird, a very good charting service. If you're interested, go to Gold Charts or Us. You can sign up for a reasonable fee per year and get access to all charts like this one. This one just shows the paper gold traded daily versus the new mining production in a given the supply. And then if you look over here, this one shows all the notional gold paper trading at the different futures exchanges, and you can see it dwarfs the amount of new supply on a daily basis. They're just basically trading so much gold in comparison to how much is either being produced or even how much exists in the world. Another news story this week was First Majestic's CEO Keith Neumeyer's decided to join a silver manipulation class action suit. Now, he's pointing out that the most recent admission by Deutsche Bank, or settlement of 2 cases, gold and silver, on the manipulation of the silver and gold price, is based on the fact that these futures markets allow this type of leverage. However, you have to show intent that they're trying to get a certain result by acting together, and that's kind of what the Deutsche Bank evidence showed when they turned over the tapes and the chat messages between the other bullion banks. They were colluding together to create certain price structures by acting in concert. However, the hard part of the case would be now that we've seen the intention and we've seen what happens, how futures markets operate, you're going to have, just in general, even without an agreement or an intention to manipulate anything, if people can buy and sell vast amounts of metal, supposedly, on COMEX or LBMA, without actually having the metal or intending on getting delivery, you're going to get distortions. It's going to look screwed up. It's not going to reflect the real supply demand dynamic. So it's a very hard thing to show manipulation because you have to show the agreement. Now, luckily for the plaintiff's attorney in the Deutsche Bank case, actually had the agreements of them trying to manipulate the price. But absent that, these types of price swings are to be expected absent an agreement. And that's the key point. The futures market creates this volatility, creates this incentive to trade amounts of gold and silver that they don't have. Okay, that's it for the review of that cable. Let's get to the week in gold and silver. Gold closed last week up 1.9% at 1172. So the first week of the year, we're up 2%. Silver closed up 3.4% to 1643. The gold silver ratio, though, however, remains at 71.3 to 1. And again, if you're interested in the gold silver ratio, click on the link. There's a link to this blog post below this YouTube, and you can check out the gold silver ratio on a daily, monthly, and 5 and 10 year basis. Also, if you're not a Smaulgld subscriber, here's an invitation to do so. You go to Smaulgld, you fill in your email address, that's it, no other personal identifiable information. I keep that private, and it's a good way to stay in touch in case the YouTube channel gets shut down, and also because you can see the charts, and these blog posts get sent to you immediately as they're published, at least not all of them, but the ones I deem more noteworthy. And you can see the charts a lot better, and there's also some links that you may want to continue to do some research that exist in the blog post on Smaulgld.com. So please sign up for Smaulgld.com. Now, also, I'm now taking Bitcoin. I also accept PayPal for donations. For those of you who have sent donations, I really appreciate that. It keeps me going. And let's see what's next. Chart of the week. Okay, so these charts of the week, they tie into what we just talked about. This one shows the concentration of traders on the CFTC. Now you got the 8 largest and the 4th largest traders. These are the bullion banks, and it shows these are their short positions. They're selling short in silver nearly a half a year's worth of annual production. They don't have that silver on hand to deliver, if to cover. This is just what they're selling, but they don't have it to sell. Even JP Morgan, who supposedly has in their COMEX vault 80 million ounces of silver, that's 10% of the annual silver mining production of about 865 million ounces. So they are easily, even the bullion bank that has the largest gold hoard listed in the COMEX vaults doesn't have that much silver or gold to deliver when they sell it short. Now, COMEX warehouses, this one is a popular chart, again from Nick Laird. At one point, there were over 500 owners per ounce. Now, that's come down to 27.65. But the key here is anything over 1-to-1, and it's subject to volatility. You can call it abuse, whatever you want to call it. It just means that traders can trade in excess of what they have. They can buy what's not there, and they can sell what they don't have. And again, that's futures trading. And unlike other futures trading, if you look at the things like crude oil, wheat, corn, copper, those commodities actually they must have them. So you really can't get too fancy with the trading because people do need the oil. It gets burned up and then it needs to be delivered. Things like gold, especially gold, to a lesser extent silver, you don't really need the gold. The reason people have gold is they want it, not so they can hold it in their hand and look at it, is they want the value of it. So they don't have to have it. It's not like they have any use for it Now, a jeweler might have use for it. They need the raw material so they can make the jewelry out of it. But investors, and that's what's on COMEX, people trading for the price exposure, they might as well be trading petunias. They really don't care. They're not looking to take delivery of the gold. That's why all these COMEX default stories are ridiculous, because you don't go to COMEX to buy gold. You go there to get price exposure. The amount of people that actually they just roll the contracts over. They're betting. It doesn't. It just happens to be called gold, but they're not buying or selling gold at all. They're buying or selling contracts. Let's see what else we had during the week, other than your request for donations. Okay, so we put out a series of YouTube videos. If you haven't seen them, in blog posts, there was one on President Johnson's 1965 warning on silver. You could check that out. I'm not going to tell you what that is. Kazakhstan added 100,000 ounces of gold. Keep an eye on Kazakhstan. They're the third largest buyer of gold among central banks. There was an article on Swiss still loving their cash, even though we're in the throes of entering into a cashless society. There was an article in Time magazine on the cost of producing pennies. Nothing you probably don't know. Each one costs more than a penny to make. Surprised the United States still makes pennies, given their views on a lot of things, but they still make pennies, and they cost more to make than the penny. Even the nickel, I think, cost at least when nickel is over $7 a ton, a pound, then it is definitely not cost effective to make nickels. I think they just about can make a nickel for 5 cents at current prices. More stories here. New York restaurant serves $2,000 pizza with gold topping. Indian Commerce Minister suggests that the Indian government lower its gold import. We'll see if that happens, their import duty. There's an interesting story here on gold smuggling, getting creative. There's my podcast with Dave on X22 report. Oh, if you're interested in buying, I mention this each and every week, and a lot of you take me up on it. If you are interested in buying gold or silver, please check out the Smaulgld affiliates, where you can compare prices and shipping on gold and silver coins, bars, rounds, whatever you wish. And if you do purchase through Smaulgld, you pay no more, no less than if you visited the sites directly, and I get a small commission. It's not advice, it's not a recommendation that you buy gold or silver, but I know some of you already have it in your minds that that's what you'd like to do. And if you'd like to do that and it's the right decision for you, then please consider making your purchases through the Smaulgld website. There's your Canadian bald eagle. That's different than the American eagle. We put out the Perth Mint annual 2016 sales report. We also did the silver. And let's see if there's anything else. Oh yeah, so we had the payrolls came out. They were lower than expectation, 156,000. Earnings were up, but they were more towards the managers. Kitco, and a lot of you don't like Kitco, and I can understand why. They're generally bearish, and that doesn't make sense for a gold dealer to be bearish. But they ran this article where the guy was saying the U.S. labor market is robust and continues to display strength. It sounds like a Reuters article, not like something from a gold dealer. That they were very respectable gains, and that the U.S. payroll added 156,000, just under surveyed expectation. No, it was a miss by 11-12%. It wasn't just under. I don't think 156,000 is robust, but that was the narrative of the day, and gold and silver went down after the payroll miss. Normally, if the payroll misses, gold and silver go up. Fed chatter, Chicago Fed president, he's talking about 2 rate hikes. That's not unreasonable. We heard this all last year. They were going to do 3 or 4 rate hikes, and they did 1. He's saying maybe 3 if the data is stronger. Who knows? We'll see what happens. There's your Perth Mint sales for 2016. People's Bank of China will release their gold editions in December. They didn't add any in November or December. So they ended the year with 80 tons of gold. That was the second most amount of gold added to reserves of any central bank other than Russia, who added they probably ended the year at about 200 tons. They added 190 through November. They haven't released December yet. There's more invitations to purchase gold and silver. Oh, the gold and silver links are also below this YouTube video. You can check them out there if you want greater variety to compare. Go to the Smaulgld website. You can see all of the links and banners. And that's about it for the week. We have the Shanghai Gold Exchange withdrawals coming up tomorrow, so be sure to check that out. Thank you very much.